Everyone, I am buying Ulta Beauty. This stock has fallen a ton as of late. Year to date, it is down 20%. In the last 1 month, it's down 13%. In the last 3 months, it is down 25%. This is a company that I've loved, and I'm now in the process of buying it, and I'm buying it at a lower price. So stay all the way to the end of this video so I explain to you how I'm buying it at a lower price than today's $396. So first, let's go over Ulta. Ulta is a $19 billion company market cap, which means you want to buy every share outstanding. You got to pay $19 billion. $22 billion enterprise value. Essentially, the difference is debt. So they have about $2.7 billion of debt. But good news, guys, they generated $1 billion last year in free cash flow. That means they can pay off their debt pretty freaking quick. And I'm sure a lot of their debt are leases because, you know, they have a lot of individual stores, and they just partnered with Target a few years ago, and they're trying to get to 800 stores where they can have their own Ulta shop in Target, which is great for both brands. Now, here's some of the things I love about Ulta. Return on invested capital. 5 years, 24%. Last year's 30%. For those of you who are new to this is the return that the company gets on the money that's invested in the business. They're still growing, opening more locations. This tells me they do a pretty good job of getting a return on that money that they reinvest and the money that's in the business, which I love. Second thing I love, they don't pay a dividend, and that'll really matter here shortly. Now, you might be, if you're listening to our channel for the first time, you might say, wait a second, he doesn't like dividends. It's not that I don't like dividends. Dividends are the last thing that a company should do with the free cash flow. You can pay dividends with the free cash flow. You can buy back shares, pay down debt, reinvest back in yourself, or make acquisitions. I don't think Ulta is really making acquisitions. So really, it's one of four things. Take out dividends. It's one of three things. And opening new locations is part of investing back in yourself. Now, guys, PE of 15, price of free cash flow of 18. I love that. 40% gross margin. I love that. And back to the dividends. I look at this and think, okay, they got all this great company going. Why don't they pay a dividend? They generate a lot of cash flow. They're $1 billion cash flow business, $19 billion market cap. Guys, dividends are the worst when you have growth potential. They're double taxation, and really paying out investors. I know it's fun to get that check, but if you can grow your profit at 10, 15% a year by reinvesting back in yourself, you shouldn't pay a dividend. If you can buy back cheap shares, you shouldn't pay a dividend. That's what's key here. And speaking of buying back cheap shares, what I love about Ulta, going to the bottom of their income statement, our software. 10 years ago, they had 64 million shares outstanding, 63.95, 62.5, 61.5, 59.5, 57.5, 56.5, 54.5, 51.5, 49.5. They buy back shares. Now, just because they buy back shares does not mean they're doing it smart. But part of the buybacks is why Ulta could be an over 400% return company based on my assumptions over the next 10 years. That's huge. Now remember, guys, just because I'm trying to buy Ulta does not mean you should. When I do own Ulta, doesn't mean you should. The key here, what I'm trying to do is teach a process. You look at a company like this, and this is why I love talking about this company. It is down 13% in the last month, 25% in the last 3 months, basically even in the last 6 months. Year to date, down 19%, 1 year down 22%. It can feel kind of icky. When you see stocks fall, you go, oh my gosh, stock is falling. But remember, the market's going to make its movements all the time. Investing is hard because of the emotional side. We can look at the fundamentals all day long, and the fundamentals can make sense. That's only 10% of what you're doing. The rest of it is the buying and holding. That's how you make the big money. But to buy and hold, you got to weather a lot of things. You got to weather up markets, down markets, perception about an individual company being good or bad. We just did a video about people's perceptions from a year ago to today on 3 major companies that I've owned. The perceptions have changed drastically. Why? Because the stock price has changed drastically. That's what's key here. I don't know where the stock is going. It's at $396 today. I have no idea where it's going. It could go to 200. It could go to 800. I have no clue in the short run where it's going, and I would never try to guess, and you should never follow anyone who tries to tell you where anything is going in a short period of time. What I'm trying to teach is this process of buying great companies at great prices, and if you're able to control your emotions, which is the most important part, when you get tight in your stomach or wherever you feel anxiety and stress, As the stock starts to fall and go against you, you've got to be able to sit there and say, okay, what do I believe about this company's fundamentals? And that takes effort. That takes time. And unfortunately, it's not something I can just go for you and say, you have it. I work on it myself all the time. I'm continually doing that because investing is a lonely road. It's so hard to be out there sometimes and see the entire world against you. But guess what? That's what you need in order to do well in investing. You've got to be okay with that. That's exactly why I created this community of like-minded investors. Thousands of investors in there who are okay thinking different. They actually love thinking different. And they talk and they disagree and they agree. They do research together. They make it easier to make better emotional decisions in investing. Because if you're able to do that, if you're able to control your emotions, as Warren Buffett and Peter Lynch always say, that's how you make the real money, is being able to control your emotions. Everybody has the brain power to buy stocks. Not everyone has the emotional ability to. So if you want to get better at your emotional side, in order to help you become a better investor, click the link below, $7 for 7 days. We're limiting our spots every day, so go sign up now. If the spots are taken, still sign up for the wait list because you'll get an email on how to fast track yourself higher up on the wait list. So go do it right now. The best $7 you've ever spent. It's a no-brainer. With Ulta, I'm looking at this and saying, here's what we got here. Let me show you some stats in Ulta that I love directly from their 10K. Here's the first chart. Now, this is directly from the 10K that I got on the main page of our website. On our software, when you click a stock, if you go to the bottom left next to the description, it hits annual report, takes you right to the SEC page. You have to fool around, it goes right to it. This, guys, is their comparable store sales at the bottom here and number of stores. January 29, 2022, they had 1,308 stores and they had 38% same store sales growth. Now remember, they were just coming off COVID the year before, so that's why it's higher. The next year, they increased the number of stores by 47 and still had 15.6% same-store sales growth. Remember, guys, same-store sales does not include the new stores. They're for stores that have been open over a year. And every company has a different definition, but this is not factoring this in. The next year, 2024, 5.7% same-store sales growth. Guys, in the retail world, to still see that, that's incredible. And they added 30 more stores. Now here are their stores by year. 2022, they had 1,264 stores. They opened 48 more, closed 4, ended with 1,308. Total square footage, 13.77. Average square footage per store, 10,500. Now, stores remodeled, 9. Stores relocated, 7. This gives you all in the 10K, which is right off our website. 2023, 1,308, opened 47, closed 0, 1,355 total. Remodeled 20, relocated 12. 2024, 1,355, open 33, closed 3, 1,385 left over, remodeled 18, relocated 7. It's all in the 10K. And guys, by the way, a lot of investors say you got to read the 10K top. I don't agree with that. I look at the 10K because I'm trying to buy larger companies. So for me, the larger the company, the less I have to read the 10K. I look at this as an opportunity to get a feel for what their plan is. 50 states, they have 1,385 stores. Now let's see that breakdown by state. So here are the stores by state, guys. All 50 states have them. So California, 170 stores, makes sense. Illinois, 55. Florida, 99. My home state of Ohio, 46. New York's got 55. So Utah, Vermont only got 1. Interesting. Who's the next lowest? I thought Hawaii would have been lower. Hawaii's got 4. Interesting. So guys, 1,385 stores. I'm sure if you do a percentage breakdown, you can see where there's some growth opportunities. One thing I would want to know about Ulta is, what is a mature business for them? Like, what is the size? What's the size number of stores that'd be mature for them? 1,400, I don't know. It seems pretty mature for 50 states, but we'll see. Hopefully, it seems like they're smart about opening and closing stores. They're not going to be dumb about it. That's really important. Now, going back to the share repurchase from their 10K, these are the total number of shares they bought back and the average price they paid. Now, the question is this good an average price to pay? Because guys, look at it. From October 29th, 2023 to November 25th, they paid basically today's price. Every other time, they were paying above. So they've gotten a negative return on that money. But remember, it's all about the future. If they thought these were undervalued shares, it's going to add a lot of value to the company. And I'm going to go through my Excel sheet to show you what I mean by that. So this is my Excel sheet. That's going to be part of our software very soon. So also, again, go make sure you sign up for that software so you get this Excel sheet in the future. And it'll all be on the website and our mobile app. What I started with was the market cap of Ulta, 19.3 billion. Number of shares outstanding, 48.44 million. Free cash flow last year, a billion 40. Now, if I assume that the free cash flow is going to grow at 7% a year, and I assume that a stable free cash flow multiple for Ulta is 20, the current price is around $3.99. It's actually $3.97 or whatever it is. Free cash flow multiple, 18.6. And to get from 18.6 to 20 in the next 15 years, the free cash flow multiple doesn't have to go up by much. But here's what happens. If they take 100% of their free cash flow and buy back their shares, and the shares keep increasing, you still get a 14.3% increase in price appreciation on the stock, even though free cash flow is only growing by 7%. Now, let's say for some reason the stock doubled today and it went to a market cap of 38,700,000. At 14.3% becomes 6.7%. That's what I mean by you have to buy back shares smart. Now let's say the market cap goes down to 15 billion. Look at this, 17.5% price appreciation. That's the power of buying back shares. Now, guys, I made a lot of assumptions here, but the point I'm trying to make is buying back shares, all things equal, the cheaper the stock, the better it is, the better appreciation rate you get. That's what matters in buying back shares smart. And I think Ulta, based on their history, could justify buying back their shares. So let's go check out what analysts are saying about Ulta. So analysts right now estimate that Ulta is going to grow its earnings per share from $26 to $43 in the next 5 or 6 years. That's some pretty solid growth there. Pretty much double-digit growth. Revenue growth, I'm actually surprised by this. 4 to 7%. I actually thought it would be lower than that. That's pretty impressive. So let's look at the 8 pillars because we haven't done that in a long time. But look at this. This is an 8-pillar thriller. We haven't done an 8-pillar stock in a long time. And just because it's 8 pillars does not mean you should buy the stock. It's about telling a story. And this story tells me, okay, they've got good multiples. They're buying back shares at decent multiples. Cash flow is growing. Net income is growing. All these things are going well. Again, not telling you, go buy it. That's not the purpose of the 8 pillars. The purpose of the 8 pillars is to tell a story. Now, before I get into this analysis, I'm going to show you how I'm buying the shares. Now, keep in mind, the strike price that I'm giving here is not based off of what I value Ulta at. It's based on getting a certain return on my money. Let me explain what I'm doing here. I'm doing what's called, I'm selling cash secured puts. What that means is I'm selling somebody the option to force me to buy a stock at a lower price at some date in the future. So let me pull up and show you exactly what I did today. So this is Thinkorswim. It's just something I use. I actually have my money at Merrill, but I use this for their platform. This is called selling puts, okay? And I picked the date here of June 7th, 2024, 29 days from today. And you can pick a long list of dates. So if I close this up, you can go as soon as tomorrow, as late as January 16th, 2026, which is 600 days from now. But I picked this date. Now, what's my goal? Well, I'm going to get money in. That money is going to be the option I sell somebody to make me buy Ulta at a lower price than today. So I want to get a 15% return on my cash. So the first thing I do is say, okay, for June 7th, what premium do I need to get based on what strike price to get a 15% return? I did $350. Now, when I did it this morning, it was actually selling for a higher price than this. So I've already got a big gain on this product, but I got paid $4.20 for somebody to force me to buy Ulta at $350 on June 7th. So what does this mean? On June 7th, when that day comes, if Ulta is above $350, above the strike price, I keep my $4.20. I don't get any shares because it's above that price. So nobody's going to force me to pay $350. Nobody's going to force me to buy it from them at $350 because they can go sell it in the market for a much higher price. They would never do that for me. Now, what if Ulta goes to $340? If Ulta's at $340, I'm forced to buy the shares from them at $350, but I still keep my $4.20. So it's essentially like I basically paid $345.80. So I have a loss here of $5.80. But guys, today the stock is at $396. I now get to buy it at a much lower price and be paid to wait for the stock to go to the price I want to. And that $4.20, let's do some math here and have some fun. $4.20 divided by the strike price of $350 equals 1.2%. But it's only for 29 days. So I divide it by 29 days and then multiply it by 365 days in the year to find out my annualized return. And guys, 15.1%. So what this means is, if I did this over and over and over again and never got assigned the shares, but I did this exact same format, I'd make 15% on my cash. And that's the beauty of cash secured puts. I get the option of, I might be forced to buy it at 350, which is a lot lower than today. But the question is this a good price for the stock? Or is today's price a good enough price for the stock where I should be selling at a higher price? That's why we use our stock analyzer tool to determine the value of Ulta. So let me pull it up here and go through my assumptions. So guys, revenue growth. I did 4, 6, and 8% revenue growth for the next 10 years. Might be a little aggressive, but I'm going to stick with that. Profit margin, I did 9.5, 10.25, and 11. Free cash flow margin, I did the same exact thing, 9.5, 10.25, 11. Now for the PE, guys, investing is an imprecise art. I don't know what PE you'd assign to it. The market average is 15. I think it's a high return on invested capital company that is smart with their cash. I'm willing to pay a premium for that. Some might argue 15, 18, and 21 for my low, middle, and high is too low. To each their own. But I also then did a desired return of 9%. Now remember, this has no margin of safety. And we need margin of safety because we're humans, we make mistakes, we don't know the future, and that valuation is imprecise. But I'm sitting here saying, like, this is the company, what's the value of the company without any sort of margin of safety? If I just want to get the market return. But remember, you should have a better return than 9% to buy an individual company, in my opinion. So before I show you the prices that we're going to get here on the stock analyzer, I've shown you my assumptions here. Let me show you how I got 370% return over the next 10 years. So let's do the math here. First off, on my highest assumptions, 8% revenue growth. Okay, so the first math is 1.08% to the power of 10. That's 10 years of 8% revenue growth is 2.15 times. Last year, what did they do in revenue? Let's go here. The income statement, they did $11.2 billion in revenue. So times 11.2 billion, that equals $24 billion. Okay, $24 billion times profit margin right here of 11%. So multiply by 0.11 equals 2.4 billion plus another $240 million. Another 0.01 of that equals $2.64 billion in profit. Are you with me so far, guys? So we have $2.64 billion in profit in year 10. Now, what multiple are we assigning to the company? 21 times profit. So let's do the math here. 20 times 2.64 is 52.8 billion plus another 2.64 billion equals $55.44 billion market cap. Okay, that's where we are right now. So again, to recap, 2.64 billion in profit times 21 times multiple is 52.8 billion plus the 2.64. $55.4 billion market cap. Okay, so we have a $55.4 billion market cap. But guys, they're buying back roughly 2 million shares a year. They currently have 49.4 million at the end of last year. Shares over 10 years, they buy back 2 million shares a year. And I'm being a little liberal here. That's 29.4 million shares. Let's assume it's 30 million shares. So now you have to divide the market cap, 55.4 billion, by 30 million shares. And what do you get here? What's your total price you get here? You get a price of $1,850 divided by $395 per share today. And that's 4.7 times for the return and percentages at 370%, almost 400%. Now, let's go back to the stock analyzer tool and see what the value we have for this company is. Boom. I have a low price of 360, a high price of 700, a middle price of 505. To me, this is enough margin of safety. I might be too conservative at 350, but the point is I just got paid 15% of my cash to wait for the stock to go a lot lower than today. Guys, thank you very much for your time.